Good afternoon. My name is Kent Scornia, President and CEO of Krilogy, and I'm here with my partner, John MacArthur, Chief Investment Officer here at Krilogy. And this is your June market perspective. Johnny, good to be with you again.
Nice to be here.
Happy summer.
Yes, full swing.
Full swing. Vacations, family vacations, travels. Lots of things going on. And lots going on with the markets, lots going on with the economy, lots going on with world affairs. Where would you like to start? Markets up?
Markets up, yeah, gosh. Shocking many. S&P's up 14% year to date. Gosh, the NASDAQ 100 is up 35, 36%, maybe a little more depending on the day.
And that is actually hitting your bullish case when you started the year.
Yeah, when we did an outlook in January, of course, there's a range of outcomes and probabilities, and that is, it's trending in that direction. I think the sustainability of that is really the next question, but and we'll get into it, but there's increasing evidence underneath the surface that things are improving.
So I'll remind everybody at the beginning of the year, John, we'll do a sort of a bear market, sort of a base case and then bull case for our advisors when they're working through their portfolios to help their clients.
Yeah, that's our team, Jake Thornton and our one of our main analysts, and Jamie Setley, Dan Larratt.
We're at the absolute bullish case scenario right now.
We're trending towards that direction,
which is surprising.
First half of the year. It is surprising. I think, last time we spoke, last time we did this, the May video, we talked about the separation in technology. And while that's continued, we contemplated whether everything else was going to catch up or tech was going to melt down. And we're starting to see things catch up.
A little broadening in the returns.
We are. And I think it's, if we look at the big picture, I think behaviorally investors were anchored and continue to be anchored in pessimism and beliefs around what should happen versus what is transpiring.
Yes.
And historically speaking, price leads earnings. And so, the S&P is up 25% plus from the October lows, all multiple expansion because earnings haven't grown. But what's happening is not only are we seeing earnings revisions stabilizing, but we're actually seeing them move up. So take industrials, for example. That is the sector that is leading earnings revisions to the upside. I mean, that's a very economically sensitive sector. So that's a good sign. I mean, I think from a catch-up perspective, if we look at kind of equal weight S&P 500 related to tech, there's a lot of room to go there.
More
potentially.
Opportunity. Yeah, because tech has really been almost the entire return of the S&P.
It has. It's been significant. Yeah, the median stock in the S&P is up 1%.
Which I think people would be shocked at
absolutely.
hearing, right? S&P up 14,
absolutely.
But the median stock only up 1.
Yeah, Jamie Setley, we do our daily meetings, shared some perspective going back to 19. Tech is actually the only sector that's outperformed the S&P.
Wow.
Going back to pre-COVID, which is pretty amazing.
Yes, it is.
I just think it's unlikely to persist. If we look at valuations out of tech, broadly speaking, we're talking about 25 to 30 times earnings, which is great, but we're in a higher inflationary, higher rate environment. There's a lot of earnings that has to then follow through to justify price and support it and advance it. So
tech has a lot of work to do still.
I think so. There's just a lot
to
of
prove out
through.
the theory.
Yeah, there's a lot of excitement with AI and what results from it. Productivity gains. I'm sure there'll be some to have. How does monetization happen in that space? And I'm sure it will, but like many things, it's going to take time. It's
very early in the game. It reminded me. I was reading an article in the Journal this morning, and I think it was a journal, maybe The Economist, and it was talking about Britons and how they are feeling about Brexit. And it reminded me of the time that Brexit was the headline.
Right, absolutely.
And how much worry the markets had about that whole issue over there. AI is sort of similar type.
Right.
It's stolen all the headlines.
It has stolen all the headlines.
Yeah.
And the excitement and attention from
a lot of investors. Yeah. Well, Brexit pulled the market down because it was worried.
And the other
AI
way.
sends it up the other
way.
Right. Flip to the Fed. Fed's meeting coming up in a couple of weeks.
Yeah, it's interesting. Chairman Powell spoke this morning and stated, and I think this is where the equity and bond market isn't fully appreciating what's potentially in store from a policy perspective. He indicated that the 2% inflation target not only wouldn't be met this year, but not next year, but 2025.
Wow.
So
Yeah.
that just suggests we could be in this higher rate environment for longer than many are assuming. And if you look at, their core inflation measures and, median PCE and median CPI, there's a stickiness component to it. And, the Fed pays a great deal of attention to unemployment and wage growth. And unemployment is at historical lows, close to it.
Yeah.
And we're seeing some cracks there, but that gives
Not
them
enough.
kind of the purview to continue tight policy maybe longer than is expected. And I think that just lends itself to, what many refer to as accidents, right?
That's
Credit crunch type events, and those you can't, of course, predict, but the ingredients are there, which is why we stated last time it's not an environment for excessive risk taking. We're not
Right.
saying sell out of equities, reduce exposure per se, but rotating to sectors that have better valuations perhaps, and earning strength going forward, and as well as globally, makes sense.
And you've always stated, don't make big bets,
Yeah.
right? Big bets in singles securities, and that
Yep.
includes cash,
Absolutely.
because you're going to miss the upside.
Well, and that's another great point. I think that we've seen investors get really enamored with what's happened on the short end of the yield curve.
Right.
The risk-free rate at 5% plus, so the attraction to go into short-term CDs and treasuries, which does make sense, a part of the big picture. What's being lost in all that, though, is the opportunity. If a recession continues to transpire, that's another buzzword, right? A
Yes.
recession, if and when and how deep and so forth. But lengthening duration can provide meaningful return if and when that happens, because rates will compress, and not only do you
Get
get
a pop in the price.
coupon, but you get price appreciation.
That's exactly right. That's exactly right.
Yeah.
Antidote on the stickiness of inflation. So speaking with a client of ours today who owns a farm, and he's building a second well,
Okay.
to drill on, or to drill a water well,
Yeah.
effectively to fill his leaking pond.
Okay.
But he built a well 6 years ago for $11,000. Today the well costs $24,000. Same
It's
well,
incredible.
same
Yeah.
equipment, same labor,
Yeah.
doubled in price.
Incredible. Yep.
That's
And
the stickiness
that's
of the
the
inflation.
stickiness. That's here to stay. If you think about wages, and we all know in hiring, and whether we're employees or employers, it's there's a lot of components to the inflation piece that are.
Absolutely. So, okay, so
that are
big
gonna be
things
here.
coming up here in the third quarter as we look forward.
Yeah, I think when you zoom out, the recession indicators, the traditional ones, are very much in place. Leading economic indicators peaked 16 months ago, and are 10% from their highs. These levels that we're at with leading economic indicators for the last 8 recessions have always preceded a recession.
Correct.
So, it's not productive to be in the game of predicting when and how deep, and whether it impacts portfolio construction or not. But I think just recognizing that future returns are likely to could be harder to come by. Another indicator, the yield curve inversion. We're a year into
Right.
inversion, and not just with the 2-year Treasury and the 10-year Treasury, but essentially across all yield curves. And that's been historically an active or an accurate predictor, but there's a lag. It's 16 months on average between inversion and when recession is announced, and we're 12, 13 months. So it's conceivable it happens at some point. Again, it's just about being properly allocated for risk, and recognizing that fixed income now versus last year can truly provide negatively correlated benefits to equity risk, as well as looking beyond that and other sources of return that can help dampen volatility.
So, question on really more client situation here.
Yeah.
You and I sit in client meetings a lot with
Mhm.
business owners who have gained some liquidity in their businesses,
Yeah.
either sold portions or part of it or all of it.
Mhm.
And it's a moment where they're sitting on a lot of cash.
Mhm.
Give us a sense of those conversations that you and I have with clients.
Yeah, it's really the portfolio construction process and conversation around overall risk, expected returns, cash flow needs, if the situation is one where supplemental income is needed. That's a really important one. Even looking at technology. I mean, it's great to recognize that the NASDAQ 100 is up 36% year to date, but it was down 33 last year.
Right.
And you need 50 to get back to even. And if you're taking money out, it's even
Gets
a
worse.
tougher game.
Yes.
So income needs, I think looking beyond public stocks and bonds is opportunistic. Private market exposure in a very diversified way, steadying returns, getting broader diversification, less correlation. I mean, certainly for that situation, cash management is really, really a big deal, because it's not been an opportunity for 15, 20 years.
Right. It does make a big difference when you can go out and get 4 or 5 percentage points on cash.
Absolutely.
Our cash-like investments.
Yeah.
At least hold you over until you
right.
get the portfolio completely invested.
That's right.
Yeah.
That's right.
So, okay. Anything else out there you want to touch on?
No, we just talked about it being an environment for not taking excessive risk, reducing correlations, and generally speaking. I mean, the market's not cheap by any stretch of the imagination. If we continue to broaden out as has begun to start, that's really healthy and could lead to further upside for the markets. But as we look out even further, just recognizing that the traditional indicators for recession are flashing yellow, and it's just smart
conscious,
to
be aware of it.
cognizant of it.
Yeah, absolutely. So thanks, John. I appreciate it. Thank you for your time, and thank you for the opportunity to be stewards of your wealth. And as always, with any comments or questions, please reach out to your wealth advisor here at Krilogy. So for John MacArthur, I'm Kent Scornia. Thank you very much, and have a great day.
Thank you.